Next area that I wanted to have a talk about is a caught in the hole trade, and I'll show you an example of this in a minute. I thought I've not done a sort of talk through a trade or how you take a certain trade on for a little while, so I'd have a look at a caught in the hole trade, which I do often reference in my afternoon streams. So first up, I think with any trade, one of the best ways to go about a trade is understand the rationale behind the trade. There's no point in just sort of taking a trade because, well, there's a level, it's going to break, it should do this. If you can understand the rationale, you can understand how it's going to break, where it's going to go, the speed it's going to break with. Similar to this type of trade. Now, the rationale on a caught in the hole trade is that positions have got themselves trapped. How have they done this? Well, what's happened is, we'll use in this example a move up. So I'll talk you all through as a move higher. What's happened is you've had a day that has been reasonably range bound. We've not done a great deal within the day. And so you can be reasonably happy to say, right, this is the area that everyone wants to do trade. That's where value is accepted. You then get a move late on which drifts towards the highs, and we close all the way up here. What that's showing you is that market has traded a long way from value. Now, all of this positioning up here is effectively trapped. Now, why or how are they trapped? Well, generally, and this is more a sort of generalization, larger time frame positions, i.e. institutional buyers and sellers, are unlikely to act late on in the day, and particularly once the cash market's closed. So say you're trading this in European bond market, equity markets is actually European bonds I've got an example of. Say you're trading it in European bonds, it's unlikely that these positions are strong positions that can keep the move going. Shown up by the fact that value doesn't shift higher. So you've now got long positioning that needs a gap up, or what they're looking for is a gap up. If they get the gap, then all of a sudden this long positioning is now being put on side. They've been proved basically right, at least until the gap fills. So that's part of the rationale. So knowing this, you've got positions trapped. What does this tell you about the trade the next day? Well, if you're long and you've run it all the way up here and the market opens there, you're now going to look at it and go, well, do I still want this? Probably not. You've held the risk overnight. Think about shorter term people. They're going to be thinking about the point of view they've held the risk overnight, they've not got paid for it, so what are they going to do? They're going to sell it. And remember, this is right on the open when liquidity is low. Therefore, even shorter term traders can start moving the market. So you're then looking for a market that's going to turn on them. They're all going to exit together, you get a quick move down. So that's the rationale behind the trade. So how do you execute this trade? With any execution, I look at it from a point of view of distinguishing factors. You know, what do you do if this situation arises? What do you do if this situation arises? What do you do if this situation arises? So whilst it's all the same trade, it's the same trade with slightly different nuances, which is then going to influence the way you execute the trade. So let's use this example again that we've just drawn. And we'll say this high here, or where we broke out, is 20s. This high up here is 60. So we moved 40 ticks away from value without shifting value. So this will be showing up reasonably low volume. Now, how I'm going to execute this trade. If we open near the extreme, and when I say near the extreme, I'm always going to judge this based on any levels that I've got near there, and also a distance as well. What you guys are thinking about is how you're going to manage your risk on this. So I'd suggest, say 5 ticks, 55s. I'm happy if we open anywhere in this range, I'm going to sell it straight on the open. So I want to be in on the first trade at the open, with the expectation that this falls quite quickly. Okay, so now you've got a couple of different trades. Open above the extreme. And when I put far above the extreme, what I mean by this, I should have phrased that slightly differently. Open with a gap. If we open with a gap up here, what I don't want to do is sell it straight on the open. If you sell it straight on the open, you are at risk that with the gap, anyone who had stops above this level gets stopped out and the market charges higher. So you now sell it and you go straight offside. So, with that knowledge, I'm then going to look at this. If it opens above the extreme, I'm expecting that you're probably going to get a few stops to the upside, because that's quite a typical situation when you open above the extreme on the very first trade. And what I mean by this could be the first 10 seconds, 30 seconds. The move back through the open, that's where I want the sell. Reason being, it's got rid of anyone who's got a stop. So the risk of it being bought up because of stops is gone. Also, you've now got a defined risk on your trade. You sell it here, your stop is above here. So you now have defined risk, whereas if you sell it on the open, you don't have defined risk. This could jump 20 ticks, 30 ticks, 40, 50 ticks. It might only jump 5 and then turn back. So that's the distinction how you're going to execute that trade. Next up, if it opens below the extreme, so significantly below. So say we open down here at 45. Well, what's happening there is what you've got to think about is, again, the positioning of the people overnight. If you're long up here and you see it opening down at 45, chances are a lot of those positions are going to get out straight on the open. They're not going to wait for it to open to see what happens and then maybe sell it if it doesn't go up. They're just going to get out, which then means all of the positioning is out straight at the open. So for that reason, you don't want to be selling it down here. Also, your risk is still above the high. So you're now taking on 15 plus ticks of risk, which is not really an ideal trade straight on the open. Also, because the expectation of the trade is that we reverse back towards value, your target's diminishing as well. So you've got a diminished target with a much greater risk. So there may well be a situation where, whilst this trade is set up, you don't have a reason to actually take the trade on. And that's what you've always got to think about. Do I actually have a reason to take it on? If we do open down here at 45s, the trade's then going to be any move back up. If we start seeing it running out of energy in this area, so volume dips off, you don't see any continued push, then I'd be willing to try and sell it, still with your stop above the high, looking for the move back through the open and then down. So you can sell it higher, you can also then sell it back through the open as well. So there's 3 different ways of playing the trade, and it varies depending on where your open is. Now, exits, targets. You've got a couple of ways of doing this. Say you get what I would call the ideal caught in the whole trade, where it opens up here at 55. You're short straight on the open. Your stop is here, 62s, let's say. You've got a 7-tick stop. Now what I'm going to be looking for is, first up, technical. Do I have any levels? Do I have any short term? Did we get a quick spike up that rejected within that day, giving you a high here? Do you have a low volume area or low volume node? If so, they're going to be my targets. The first move is often quite quick and then people take their profit. So on the first initial knee-jerk down, any clear level that I've got is going to be where I look to take profit straight away. Then you've got an element of holding it right the way back to value, which theoretically should be the trade because value has not managed to shift. But this can take much longer. Also, if you do get consolidation in these areas, so a trade sideways, value shifts back up and therefore we don't get the move down. There's a price action exit. That is essentially, as soon as you get the quick move on the open, you get out of the trade. That was exactly the catching of those longs. Drops down, get out. That's your price action exit. Combination is where you go in with perhaps slightly bigger size, and you go, so say it opens 55, you sell 2 clips. One becomes a price action exit, which you exit immediately on the drop. The next, you hold for a technical reason. And you say to yourself, right, this either comes back and hits my stop, or if it starts to range like this, it breaks the range, you get out on a technical basis and you try and hold that other clip, creating potential for a much larger winner. Equally though, creates potential that you take the first win and then you cancel it out with the stop out. Okay, when and where are you wrong on this? In terms of a stop, my stop is always going to be above the high, assuming that you open within range. If you open outside of range, then it's above the extreme. So, like I had in that example, if you open above range and it spikes up and then comes off, your stop's above the extreme. So that's always going to be my view of where the stop is. When are you wrong comes down to the way it trades. If it, say, opens lower and just gets bought straight up, so you get a quick drop down, move back through the open and gets bought up, that's when you're wrong on the trade. Equally, if we get the gap up and it's just trade straight higher, you're wrong on the trade there, if you're taking it straight from the open. So that's what I want you to think about. And have all these elements planned out beforehand. You're going to be able to know where the open is, so you can say, right, this is trade 1, 2 and 3. You can decide what your exit and target is, depending upon personal preference, what you feel more comfortable, where you feel that your best risk reward lies. Now, I've started to change this strategy and I'll show you it in an example. Now, my original strategy on this when I first started looking at it was, well, we've closed up here, so you can see low volume, late move. Therefore, I want to sell the open. Now, the open opens above the previous high, so I'm not keen to sell it straight on the open, but as soon as we get inside, then I'm willing to sell it. So, short inside the range, and I started to adjust this trade because what I was finding was that you get shown onside very quick, and my view was always, right, I'm playing it back all the way to value and VPOC. The longer it then spends in this area, and as you can see, 2 hours later, we're still trading in the top part of the range. This is effectively shifting value up now, so the likelihood of it coming down is less and less and less. So I started to change the trade, and this is what I mean by deciding on how you want to get out. Changed it to a more price action based trade. You can see on a 1 minute chart that that's the first move. First move goes from 50s straight down to 36s. 36 just through the close from the previous day. And this is why I was saying, pick out clear areas that you can take some profit on, because on that first snap down, that's where you get the quick payout. We then see, we trade all the way back to the high and then come off. Now this puts a lot of doubt into the trade, and my view of it is now that actually I'm better off to take the trade, take the initial trade with bigger size and take the fast exit than smaller size and try and hold it for the bigger move. Because the low that it manages to achieve fills the single prints, and that ended up being it for the day. So if I'd held on to this, still end up getting stopped out perhaps 3 hours later on a trade that what you're trying to do is catch out the position in overnight. Now, that position in overnight by 3 hours later is probably out of the trade. So my view of it has now changed, that I prefer to take it with a bigger size, take the fast move and be out. That's a personal view. If you have a greater technical reason for being short up here, then it perhaps is giving you a very nice entry. But my view of it now is that I prefer to take the fast in, catch the people out trade, and then if I do have a technical view, then it may be a combination trade. So I would do perhaps accept that I'm going to hold a little bit of the size, accept that yes, it's going to take a loss, but the majority of it is going to come out on that first reaction area. So that's the caught in the hole trade. Something to watch out for. Now, one nuance of this is it often comes about on the back of an event. So particularly FOMC, because of the fact that the Fed obviously releases its interest rate decision after the European market has closed. So in the European morning the next day, you often get a situation where European bonds track what the T-note does overnight, open away from value, or close away from value late on, open up there as well the next day, and then come straight off because value then takes precedent over the move that had happened the night before. So watch out for those, any extreme moves late on, particularly if they're extreme moves caused purely by a correlation to another market rather than a move that's actually generated by this market in particular.